Hello everyone and welcome back to my channel. Today we're diving into some significant changes in Canada's mortgage landscape that took effect on December 15, 2024. These reforms are designed to make home ownership more accessible for Canadians, especially first-time homebuyers. We'll break down these new rules in simple terms and explore how they might impact you. Let's get started. Let's start with a brief overview of the new mortgage rules. The Canadian government has introduced two major changes. Number one, increase insured mortgage cap. The maximum price for insured mortgages has been raised from $1 million to $1.5 million. Number two, extended mortgage periods. Eligibility for 30-year amortization periods have been expanded to include all first-time homebuyers and purchasers of new builds. Now, what is an insured mortgage? An insured mortgage is one where the borrower makes down payment of less than 20% of the home's purchase price. The insurance protects the lender in case the borrower defaults. With the new rules, more Canadians can access insured mortgages for higher priced homes. For example, previously if you wanted to buy a home priced at $1.2 million, you needed a minimum 20% down payment of $240,000 because the price exceeded the $1 million cap of insured mortgages. Now with the cap increased to $1.5 million, you can purchase that same $1.2 million home with a lower down payment, potentially as low as $95,000. Now let's understand amortization periods. The amortization period is the length of time it takes to pay off your mortgage in full. Extending this period reduces your monthly payments but increases the total interest paid over the life of the loan. Let's say you're purchasing a $600,000 home with a 10% down payment, resulting in a $540,000 mortgage. On a 25-year amortization at an interest rate of 4%, your monthly mortgage would be approximately $2,844. Whereas on a 30-year amortization with the same interest rate, extending amortization to 30 years reduces your monthly payment to about $2,573. This extension lowers your monthly payment by around $271, making home ownership more affordable on a monthly basis. So, what would be the impact on first-time homebuyers? Well, these changes are particularly beneficial for first-time homebuyers, like lower down payments. With the increased insured mortgage cap, first-time homebuyers can enter the housing market with a smaller initial investment. The monthly payments will be reduced. Extended amortization periods means lower monthly payments, easing the financial burden. Let's consider an example. A first-time homebuyer looking at a $1.2 million home, according to previous rules, required 20% down payment, which is $240,000. According to new rules, now only 5% down payment on the first $500,000, which is approximately $25,000, and 10% on the remaining $700,000, which is $70,000. And totaling up to $95,000. This change reduces the required down payment by $145,000, making it easier for first-time homebuyers to afford a home. Consideration for homebuyers. While these reforms offer advantages, it's essential to consider things like total interest paid. Longer amortization periods mean paying more interest over time. Home prices. Increased demand could drive up home prices, potentially offsetting some benefits. Financial discipline. Lower monthly payments shouldn't lead to overextending your budget. So, Canada's new mortgage rules aim to make home ownership more attainable by lowering down payment requirements and monthly payments. However, it's crucial to weigh the long-term financial implications and assess your personal circumstances before making a decision. If you found this video helpful, please give it a thumbs up and subscribe for more updates on real estate and personal finance. If you have any questions or thoughts on the new mortgage rules, feel free to leave a comment below. Thanks for watching. See you next time.